Good afternoon, everyone. We're just going to allow another couple of minutes to have a few more people log in, and then we'll get started. Good afternoon. This is Marianella Collado. We will be starting in just a couple of minutes. We're just going to wait for a few more attendees to log on, so we will be right with you. Good afternoon, everyone. This is Marianella Collado. I am the CEO and Senior Financial Advisor here with Tobias Financial Advisors. With me today is Matt Sainholz, who's our Chief Investment Officer and Head of Portfolio Design.
Good afternoon, everybody. So just a quick reminder as we're going into this webinar today, and we're happy to be here. But we do want to make sure that this is an informational webinar. We're doing this to educate the community out there about what's been happening in the markets the prior quarter and what might be happening in the future. This is not specific advice to your portfolio. If you have questions regarding your specific circumstances, please reach out to your advisor here at Tobias Financial Advisors, and we'll be happy to go over some of these themes and how these themes that we cover today may affect your specific portfolio.
So a little bit about us. We, as you may all know, we were founded by Ben Tobias in 1980. We currently manage $350 million in assets for families, their trusts, their family partnerships, and their businesses, 401ks. Cumulatively, all combined, we have over 75 years of experience in investment management, financial planning, me having a very strong tax background, and Matt complementing me very nicely with the investment background. Most of our team members have designations such as the Certified Financial Planner, CFA, and we have now 3 CPAs on staff. So before we dive into our agenda, I thought it would be just a nice overview to help us put all the information we're about to receive from Matt into perspective with regards to the overall financial house. I think it's important to understand what our overall investment philosophy and the way we approach investment management. In effect, it's the idea that we want to focus on the things that we can control. So creating an investment plan that fits not only your risk tolerance, but your need. And this is what I like to refer to as goals-based investing. We have to make sure that portfolio is designed to meet all your needs versus trying to chase specific market return. And this way, this takes the pressure off because you know you've looked at it at a time when you were calm and that was the right portfolio for your specific situation. It's important to design a portfolio to maximize return as well as diversifying risk. So diversifying your portfolio in terms of not only bonds to bonds to equity, but also, I'm sorry, were we having an issue with the slides? Okay, is it working now? Okay, excellent. So diversifying the portfolio is very, very important, especially in a time where we see volatility. We were spoiled in 2017. So being able to have a portfolio that's broadly diversified not only equities to fixed income, but also U.S. versus non-U.S. That's what we call a very broadly diversified portfolio, not putting all your eggs in one basket. Another one of our main focus is reducing costs. So if it's not essential to our objective to make trades, we don't want to make trades just for the sake of making trades. We look for opportunities to rebalance, to take advantage of tax planning opportunities, especially I think the markets cooperated very nicely with my objective to find losses at year end. So, while it wasn't pleasant on the investment side, on the tax side, it provided me with a ton of opportunity to be able to realize a lot of those losses to magically make tax disappear. That's the magic in overall holistic investment management and wealth management.
Right. And Nella hit it right on the head. It's hard. A lot of people may have been emotional last quarter with the investment returns, but you have to take it in perspective on how it really affects your life and your goals, and keeping that in perspective.
And the last point here, minimizing taxes. Again, we just talked about loss harvesting. Yeah, that's a tax planning strategy, but this also alludes to the fact that let's say just assume 7% return in a portfolio that's not designed in a tax efficient way is not the same as 6% in a tax efficient portfolio, right? Because if you're earning 7%, but it's not being managed in a way that allows you to keep the bulk of that return, then 7% for someone in the highest tax bracket is more like, 4 or 5% versus 6% in a tax efficient portfolio. And so there's quite a few things that, as holistic type investment managers that you have to focus on, because there are a lot of moving parts. So I thought it would be important just to kind of preface the discussion on overall objectives, and investment management and market performance is just one little piece, and that's what we're going to dive in today. So our agenda, what we're looking to cover today, is going to consist of what happened in the fourth quarter. We'll look at 2018 and see what markets did for the entire year. We'll talk a little bit about what some of the questions a lot of you were calling and asking us, and what were some of the themes that we were seeing throughout the year and specifically in the fourth quarter. And we'll talk a little bit about what our expectation is for 2019. And then we'll hopefully allow some time for some questions, as I hope you all have.
Right, and so the administrative or housekeeping section here, before we dive into the 2018 returns, there should be a way while you're looking at your webinar to submit us questions during our presentation, and should be able to see those if they're entered properly. And so at the end, we'll try to address some of the questions that may come in from our audience today.
So with that, we'll pass it off to Matt, who's going to walk us through 2018 fourth quarter performance.
Wow, yes. Well, Happy New Year, everybody. We here at Tobias Financial Advisors wish everyone a Happy New Year, and we could not wait to turn the page into 2019, given this slide that we're about to review here for 2018 fourth quarter. There's a lot of red arrows pointing down on this slide. So what happened in the last quarter of 2018 was a correction in the financial markets, as defined as a 10% drop in equity performance. The U.S. stock market experienced a 14% decline in just the fourth quarter, and you can see international stocks were down 12%, emerging markets 7%, and then on the right hand of the screen here we have the fixed incomes, or the bond part of the portfolios, were actually up in the fourth quarter. So there's a lot of drivers that created these downturns, mainly the idea of a slowdown in the economy and in corporate profits for a lot of the uncertainty in the fourth quarter, as well as a looming government shutdown, as well as the U.S. Fed potentially raising interest rates faster than what the economy or what a lot of market strategists would say might be too fast for the economy and putting them into recession. So there's a lot of uncertainty, and just on top of the fact that we were having a really pretty positive year in 2018 and the prior years to that the market was due for a correction. August 29th was the top of the NASDAQ, which is a more technology-based benchmark, and that benchmark, the NASDAQ, was entered into bear market territory. That was down 22% from the August 2018 through the last couple weeks of December. It was down 22%. We had stocks such as Apple, some of these blue chip technology stocks, down anywhere between 30 and 40% in about a 3-month period. So there was a lot of volatility out there, a lot of a downturn. The S&P 500 here was down 14%, as I noted.
So just to add a little bit of color here too, I think what started happening right before we entered the fourth quarter, where prior to the fourth quarter, U.S. was actually performing very well. So we had a Fed chair who was basically steadfast on the idea of raising rates irrespective of what markets were doing. And so when that announcement was made, the markets didn't take very lightly to that. So hence kind of that fourth quarter downturn. And then the other thing that just inherently happens in investing is, investors are looking for yield at the end of the day. And if we can get safe yield, then why take, the risk of being in a volatile market? So it's almost this idea that as yield goes up, as the rates go up, your kind of equities and bonds are competing for the same dollars. So that's kind of what I feel happened kind of in the fourth quarter.
Mm-hmm.
So
sure. So we'll move forward and kind of show results for the year. Then after coming off that fourth quarter, we had the S&P 500, the U.S. representation of the U.S. stock market. It was down about 5% for the year. Nella noted there it was actually having a pretty good year heading into the third quarter. And so for the year, we have our major stock market indices down across the globe for 2018. 2018 with the S&P 500 down being down 5%. That was actually the worst return that we've had since 2008 in the U.S. stock market. So we had a good 10-year run of positive returns, and the down years were pretty minimal. Whereas this year being down 5% in the S&P 500 was the worst year since 2008. You see international, emerging markets, and then even bonds. So the U.S. bond market was up 0.01%. So that is flat. The U.S. bonds did not have any returns for the whole year of 2018. And we'll dive into this later into our presentation, that the rising interest rates have caused some downturn in the value of the bonds. They still might be paying a yield, but the total return, because interest rates have risen, made it as such that the U.S. bond market, what's the conservative part of most people's portfolios, actually yielded 0%. So that contributed to an overall negative years for most balanced portfolios out there.
Right, and just a little context, because I remember that somewhere around summer, we were getting a lot of calls on, well, Nella, why wouldn't we just overweight U.S. and just get out of international emerging markets? And I think the prior slide showed that very nicely, is that, at that point, you're almost allowing your emotions to try to dictate investment decisions. And so had that been the case, had we overweighted U.S. Just to try to, take advantage of positive U.S. market returns, we would have experienced an even worse quarter than had we just stayed globally diversified. So that's something that, we try to remind our clients of, and it's very important to kind of keep the overall long-term goal in mind.
Absolutely. That's a perfect segue into our next slide, where we'll be looking at global equity markets. This is stock markets around the world and their sorts of returns. And I like to kind of first look at the pie chart in the top right, which shows the different capitalization of different corporations across the globe. So the U.S. accounts for about 54% of the world's equity capitalization. That just means publicly traded companies around the world. 54% of the world stock market is headquartered here in the United States. But if you just turned your back on you're just U.S. centric, you would be forgetting about a lot of global countries around the world, and this is a global economy. So, we want to keep that in mind when we talk about balanced portfolios and where we see value for 2019 going forward. So we want to keep that in mind. It is a global economy. As we saw on the previous slides, there was nowhere to hide and stock markets around the world for 2018. It was a tough year, and we are optimistic for 2019. So just looking at some of the individual countries, we tend to kind of just lump it all together as international versus U.S. But this is kind of a good indication and just kind of proves that, maybe some countries like New Zealand and Israel and the U.S. were in the top 3 this year. Even though they weren't positive, they still were in the top 3 performing countries across the globe. Whereas Germany, who's a tremendous power in the economic world here, was down 22% in 2018. And you contrast that with some of the emerging market countries, which are on the right-hand side of this chart.
And we have an outlier there, don't we, Matt?
Yes, Cater, 27% positive, but that's kind of the idea of that you can't time the market and you shouldn't chase returns, because we went back a year ago, these countries would be a completely different order, and the returns from year to year aren't correlated. And so just because one year the U.S., for example, might have been doing well, it doesn't mean the next year that it's guaranteed to do well again. So this is just kind of a snapshot of different country returns.
And I think Israel is an example of that. I think in 2017, Israel was all the way at one of the worst performing countries in 2017, if memory serves me right. And this year it's the second. But just a little bit of context on what's happening within these countries. There's an organization that tracks sort of whether countries are expected to expand or contract. And in 2018, 44 of the 45 countries tracked by the Organization for Economic Cooperation and Development were all on pace. 44 of these countries, of 45 countries tracked, were on pace to expand, and the only one that was not on pace to have an expanding country was Argentina, which was expected to contract. So even though we're seeing GDP growth for all of these countries, there are a lot of things we can say about the fact that they've still had negative return in the market. Mm-hmm. Probably mostly attributable to trade wars and a strong U.S. dollar.
So finishing up 2018 returns, we just want to kind of look at the fixed income or bonds, and what happened in those markets as well. So fixed income returns, if we're looking at just the U.S. Treasuries, there's a lot going on in this chart, but down the middle of 2018, the 2-year and the 5-year had positive returns of 1.4% in that area. And as I noted way at the beginning of the presentation, was that the fixed income as a whole yielded about 0% return. And so you had the shorter bonds that matured and then in the 2 to 5 year range had positive returns, and you contrast that with bonds that mature in 10 or 30 years from now, those had negative returns. When you put that together, it was a 0% type of return. And this is where you use a portfolio manager who is able to kind of tilt between longer term bonds or the shorter term bonds and get a total return for your portfolio. So that's kind of the story of what happened in fixed income world in 2018.
So one of the things that I felt like I was having this conversation like a broken record is, why not just sit tight and sit on cash? Maybe look for a high yield savings account and just have no market volatility, but earn 1.5%, 2%. And that's fine for what we consider emergency funds, sort of cash reserves, but long term, that's not a good strategy. However, one of the things that folks may want to consider if they are sitting on significant cash positions is consider FDIC insurance for, what is the coverage on large sums of cash sitting in a banking institution where the FDIC insurance might be up to $250. It could be more depending on how the account is titled. But versus treasuries, which is something that we've been having a discussion on, building sort of a U.S. Treasury portfolio for significant cash holdings. So it's something that we'll be having discussions with our clients on an alternative approach to significant cash holdings, just because we don't necessarily want it sitting in a bank where FDIC insurance is not going to cover it, but you can still capture some yield going forward.
Absolutely. So outside of the what to do with our cash question that we do get at certain times, we are going to now shift towards some of the questions that we're hearing now and some of our outlook for 2019. I'm just going to hit some of the questions that we hear frequently. The U.S. is a global leader. Why do I need to be diversified? I'm hearing about this, the next best investment. Should I go all into it? There's a lot of volatility, and that was different for 2018. But was it really that different? We're going to be examining longer-term periods of different types of market swings and volatility in the few slides ahead. We'll be talking about interest rates and just U.S. global economic outlook, as well as what you should be considering for your investment makeup as we move into 2019 and beyond.
So, we kind of touched on this. We're calling it S&P MV. Effectively, for the first part of the year, we were getting a lot of those calls on why do I still have an international allocation? Why am I holding emerging markets? The U.S. is performing perfectly well. And I think we've kind of beat that dead horse, is that, fourth quarter really turned on U.S. markets, and then it had its worst quarter. Worse than the other sectors. So this is an example. If we look at the years 2000 to 2002, the S&P had a negative return of 37.6%, whereas a diversified portfolio was down just 5.6. I'm saying down 5.6, but this goes back to this whole idea that, markets are efficient. They're going to basically price in everything that's happening for the most part. And the idea of maintaining this balanced portfolio is going to allow you to participate on the market upside, but more importantly, protect you on the downside, because it's harder to recover from an almost 40% drop in the market versus a just 5.6 drop in the market. And I think, if we kind of run through numbers, we can show how in the long run, over a 10-year period, a portfolio that's having these wild swings is going to underperform a more balanced portfolio where it's kind of having a smooth ride. And then we look at 2003 to 2007, the S&P was up 82%, whereas a diversified portfolio only up 61%. So this is where I didn't make as much. Those are the calls that usually happen around that time. 2008, another example. S&P down 37, diversified portfolio only down 17. This kind of is looking like the damn if you do, damn if you don't type slide. 2009 to 2017, S&P up 258% versus 152% for a diversified portfolio. Again, I didn't make as much. 2018, S&P down 4.4, diversified portfolio pretty much neck and neck at down 4.6. But I think that the point that we're really trying to hit home is that it's harder to recover from these wild swings. If you look at an investment of $100,000 for that same period, a portfolio that would have just held the S&P would only be up to $246,000 versus $266,000 in a diversified portfolio.
Right.
And again, that's because it's so much harder to recover from a 37% drop or 40% drop. you just need the market to do that much better in order to make up for that bigger loss.
Right, and from an emotional perspective, obviously a diversified portfolio lets you sleep at night a bit better, knowing that you are spread out across the different asset classes and not all tied to the S&P 500, which clearly has higher swings compared to a diversified portfolio. So let's take a look at what a diversified portfolio is made up of and what it did in 2018 as well, as far as different types of returns. Nell and I can both describe this chart, but what you're looking at, where we have the black box outlined for 2018, each color represents a different asset class from left to right across the different years. So in 2018, cash was up 1.8%, which was the best asset class in 2018. And as you could go back all the way back to 15 years to 2004, we haven't seen a year like this where cash was the best performer in the last 15 years. And that just kind of gives you the type of environment that we saw in 2018 as far as what happened out there. So we already kind of went through the different asset class returns. What this is really showing here is this is provided by JP Morgan, and they come up with a asset allocation, the gray box with a line through it throughout the middle of this chart. That in each year is a combination of all the different asset classes. So that gray diversified portfolio is towards the middle. It's never at the top and it's never at the bottom. Over the last 15 years, this diversified approach on an annualized basis did 6% a year, and the volatility averaged about 10%, either plus or minus 10% on an annual basis. So you got about a 6.62% return if you were invested in a broad-based portfolio over the last 15 years. And that's kind of what we use this chart to kind of show our clients and people that we work with throughout the community that the broad-based approach is the best, because from year to year, it's hard to always pick the winner, and it's hard to do that.
Right, and just to point out, what stands out to me is if we look at the far right-hand side of the chart, where we see the top performing asset classes, REITs, which had a 8.5% annualized return during this whole period, but you would have had to stomach a volatility of 22%. So it's not going to feel good in a year where you're making significant declines in the market. And emerging markets is right up there. It's the second best performing asset class throughout this whole period at 8.3%. So we do believe that these are essential components of a portfolio, but trying to pick between the leader is going to be a losing proposition, because you can tell that the colors are all over the map. So it's going to be hard to predict from year to year which box we want to be in.
Absolutely. And this is a chart that we like to share. So if anyone would like to spend more time, there's a lot going on with this chart. We realize that. So if anyone would like to spend more time reviewing this chart, we'd be happy to go over that with you. Just please let us know.
So Bitcoin, this was a question that was a very hot topic. 2017, this was coming up almost every day. What do you guys think? Should I invest in Bitcoin? And so what this is showing us is we do not believe that this should be part of someone's long-term retirement portfolio. For us at this moment, this is not a viable investment strategy. If someone wanted to dabble in it, our response was always, well, just invest what you're prepared to lose, was pretty much our thinking on it. And we can see clearly, because the questions were coming up towards the end of 2017, 2018, what do you think? Should I invest? And you can see Bitcoin took a significant dive. So I think a picture is here in this case worth 1,000 words.
Mm-hmm.
So I don't know.
Yeah, absolutely. So I think this just goes into the reminder of not getting caught up in the latest and greatest hysteria, because this time last year we were fielding so many questions about Bitcoin, and people were piling into Bitcoin, And unfortunately for them, hopefully they were diversified, but unfortunately if they were not, they suffered tremendous losses. So this is just another reminder that it might be cannabis industry, the marijuana industry, or maybe it's your own personal company stock that you are a corporate executive and you have a large piece of your pie into your corporate stock. So you want to be diversified, and this would be a good opportunity as you're looking at your 2019 to-do items and your New Year's resolutions to think to yourself, let me look at my financial picture from the whole pie perspective and see where my risks really lie, and to really understand that you don't want to have any one asset class have so much exposure.
And sometimes, Matt, a question we get is, well, I do have a concentrated position, but, if I were to dispose of this position, I'm going to have significant capital gains and hence significant capital gains tax to pay. So, there's a lot of planning that goes around diversification and how to do it in a tax efficient way. Most of you already know that I'm a big fan of donating appreciated stock if you were planning to make a donation anyway. And there are other more sophisticated tools that can be used to diversify a significant portfolio without having to pay all the tax in the year that you diversified. There's a ton of different vehicles that can be used, and if anyone has that specific situation, I'd be happy to go over that as well.
Absolutely. So the return of volatility. Let's spend a few minutes thinking about what we experienced in 2018, and was that new to the markets? Is that something that it was just an anomaly and an outlier and won't happen again? So what you're looking at here, each of the blue bars represents a day when the stock market had a return of plus or minus 2%. Either way, a positive day or a negative day of 2%. And I guess we were just spoiled. When you look at 2017, we had 0 days where we had the volatility of a plus or minus 2% return. If you look at the average dating back to 1950 in the U.S. stock markets, the average is about 11 days where we'll experience that type of volatility. So coming off the heels of such a smooth year in 2017 and then getting thrust into 2018 when there were actually 20 days that were the plus or minus 2% return days, yeah, it definitely had a lot of investors questioning their philosophy, questioning, can I really live with this market volatility? This is definitely different. It's different this time. Something's happening. It's different this time. And we're trying to educate and get out that, it happens. Markets are volatile. It's kind of like the weather where you might have a really cold day and then be right back up at 80 degrees. But over the long term, the climate here in Florida is nice and sunny.
I was going to say in Florida.
in Florida. So, what do we expect for 2019? I would say that we're going to be more around the average. Mm-hmm. We're not foreseeing that we're going to go back to 2017 to have no volatility. We would probably say, 10 to 15 days of plus or minus 2% returns, sticking around that long-term average. It's interesting to see back in 2008 there was actually 72 days with that type of volatility. So I would go on the unprecedented 20 days above average, but we've seen that before.
Right. But I think also, Matt, what is feeling like an alarming situation for people is that you turn on CNN and you're just seeing the Dow is, down 600, up 500. So from a points perspective, right, it looks like It's an alarming situation, but the truth of the matter is that we're just dealing with a much bigger market. So, right, and I think that's why just kind of putting it in perspective, yeah, you might hear of a 600-point drop, 600-point increase, but it's a bigger market. So again, it falls under, that 2%, sometimes under 2%, but from a points perspective, it looks like the sky is falling.
That's a great point. You have to keep it in a percentage basis to remain calm and invested and not get too worked up.
Okay, and the theme here for this page, again, just to sound like a broken record, is that with increased volatility, it just really underscores the importance of diversification and discipline, and not trying to time the market, because you're not going to get that right day in, day out. It's hard to predict, it's hard to time. So diversification is going to be the name of the game, given this level of volatility.
Absolutely. So where are we in the U.S. economy for 2019? Well, we're coming off 2018 where we saw GDP growth just below 3% for the year, which is a healthy economy. We're doing strong. Some of the numbers that economic data that we look at, unemployment figures are low, and for the foreseeable 2019, they should still remain in a low unemployment and low growth situation, which, if that does occur, that would put us into the record books. On the left-hand side of this chart is the length of U.S. economic expansion in months, and you can see at the bottom from June 2009 through December 2018, we've had 114 months of positive economic data, and we have yet to see a recession during that time period. So if we make it out throughout 2019 as this slow growth, the 2 to 3% growth in the GDP with no recessions, that will put us into one of the longest expansions that we've seen in the U.S. economic history. But I guess just to kind of contrast that, if we do see a recession in 2019, which is not our forecast, typically they're shorter in duration than expansions. The capitalism works, the U.S. economy continues to chug along. When there is a recession, you might see 8 months to a year worth of slow economic data, but typically the U.S. will pull itself out of that within a year or so. So there is a lot of talk, a lot of speak that you might hear on the economic news channels about recession is looming, this longest expansion, it can't last forever. Well, that may be true, but I do think it will set a record. The expansion is one that's been kind of marked by slow growth, or it's not 6-7% a year GDP growth, but it is still growing. It's still an economy that's growing at 2 to 3%. Households with looking at their debt service, meaning how much debt is on the books of personal households, it's one of the lowest we've seen in about 30 or 40 years. So the consumer seems to be in a healthy shape. The economy is still growing, and that's why we're still optimistic for 2019 and beyond. And that's one of the major reasons that we do think that the stock markets will be positive for 2019. So more outlook, more what is worrisome during the upcoming year. What's happened since the fourth quarter, where we just recapped that we were almost at a bear market in the S&P 500. We did hit a bear market in the NASDAQ. We've had two pretty substantial news events already in 2019 that's kind of soothed the market, and we've seen some returns. In fact, we've already made up about 50% of the drawdown that we saw in the later half of 2018. We've seen one of the major ones is trade talks. We've heard China and the U.S., the two largest economies in the world, are thinking about playing nice together. We do hope that there is a deal in the short term, and that's one of the reasons why the market is pricing in some positive results here in the early 2019. So we'll have to keep an eye on that and see what comes next in the negotiations. But ultimately, from a purely economic standpoint, freer trade and trading with less restrictions is better for both countries involved. That means that they get to export what they do well and then import what they could use help with. And at the end, in theory, in economic theory, that benefits everybody.
And then equity performance, what we're expecting is that we're not going to see the highs that we were seeing during 2017, but we expect that, and especially for us, we have a value tilt in our portfolio. We expect that those particular companies, which are your blue chip dividend paying stocks, will have a good 2019. That's usually the case after a market decline. So people will be flocking to your dividend-paying stocks, which will help the value sector. International for us, we still see opportunity. We can almost look at them and they're on sale. So we have, in effect, rebalanced our portfolios to stay on track with what we should have in emerging markets as well, because we're seeing opportunity there and that they're fairly inexpensive. And if things work out with China, that should cause emerging markets to perform well, especially when tensions die down and we start reducing the number of Fed interest rates we're going to have. We should start seeing a weakening U.S. dollar, which will help our international and emerging markets allocation.
Right. So for the bond yield story, which is the U.S. interest rate structure, where that was the other piece of big news that we saw at the beginning of 2019, and it was more of a comment from the Fed Chairman Powell at the beginning of 2019, where he basically said, okay, he kind of tipped his hat and said that the Board of Governors is not going to raise rates without thinking about the ultimate effects on the economy, and that kind of soothed the market. And instead of people pricing in maybe 2 or 3 interest rate increases for 2019 from the U.S. government, most economists at this point are expecting maybe only 1 increase, and some even expect no increases because of a little bit of just the fact that they don't want to do it too fast. They don't want to raise interest rates too fast. That would cause us to go into recession. So another reason that we are optimistic about 2019 is that we are going to be kind of seeing a low interest rate environment still. The household debt and the consumer be healthy, and the just general economics with the economic growth to remain stable. And so these combinations combined, don't see that many gray clouds on the horizon as from the economic perspective. As I say that,
you say that, I'm thinking, what about the government shutdown, Matt? Because this could be a whole domino effect if it continues. I mean, you think about what's happening. You have unpaid workers. That's going to be less production in our country, which is going to contribute to a slowdown. You're going to have less consumption because now you have, I think it's 800,000 employees basically unpaid today, and so there's less consumption. So all of these factors could have an impact on the GDP growth for 2019 if we don't put an end to this.
Absolutely. I think right now the market's kind of pricing in that the shutdown will only be temporary meaning a month or two. If we see prolonged government shutdown, that would perhaps derail what were some of our optimism. But I think that there will be an end to the shutdown soon, and ultimately we're going to see a lot of politics. I mean, not that we're missing politics. We hear it every day, but here comes, we've already seen a couple of announcements from Democrats who are going to be running for 2020 presidential election. So we're already starting to see that early in 2019. Throughout the summer, we're going to have more people throwing their hats into the political ring. And we keep an eye on this, but ultimately we do think that you can't really time the market based upon politics. And so it's just one thing that might slow the economy or act as a drag on the economy with the government shutdown. But ultimately, there's always been politics. There's always been a push-pull between our nation's leaders. And the U.S. economy has continued to pull through since the 1920s, so and before that as well.
So that covers our outlook.
Yes, that covers our outlook and the majority of what we wanted to cover for today. We've recapped 2018 that was tough on our returns, on our portfolios, and our emotions, and just wanting to, we can't control the market, but we have to realize that we're investing for the longer term. And so let's see if we have a couple questions rolling in from the audience. And before we get to the questions, we do want to mark that Jack Bogle passed away last week, which he is a pioneer. He was the founder of Vanguard Investments and a pioneer in the investing world, and he has left a mark on the how we construct portfolios today. He was a true champion of low-cost investing.
And the fiduciary. I mean, that was one of his biggest things is low-cost investment and working with someone who is a fiduciary who has their client's best interest at heart. So that was a big loss for the industry, to say the least.
Right. So we do have one question coming at us, and that's emerging markets. And what do we think about emerging markets, and how does that fit into the portfolio? As a reminder, emerging markets are countries that, kind of as it sounds, are maybe growing. They might not be as stable politically, or they might have something in their economic environment that has not quite matured to the level of like a United States or a Japan. So the top ones are mostly considering China, Brazil, India, a lot of countries that are kind of the manufacturing, high growth type of atmosphere.
And most people are surprised when they hear China is in the emerging markets sector. It's interesting.
Yeah.
So, we touched on this a little bit. I think once we have some de-escalating trade tensions, which it's looking like we're hopefully get some sort of an agreement on the positive side, that should help with the U.S. dollar. So as I had mentioned, a weakening U.S. dollar will help emerging markets performance. Again, as we had mentioned, I mean, if we look at valuation, price to earnings ratio, historically, the biggest value is in international and specifically emerging markets where their price are below their 25-year average. So to me, this is an opportunity of, making sure you have an emerging markets allocation. It doesn't have to, I wouldn't say all in, again, just moderation, but it definitely has a place in our clients' portfolios, and we believe that there is opportunity going forward.
Completely agree. Thanks, Nella. So I think we're going to wrap up we're coming up to about 50 minutes here. We're going to wrap up our presentation today. We enjoyed the time, and hopefully you learned something new today. And please do contact us if you'd like to discuss your portfolio, if you had any questions about the information we covered today, and we do look forward to working with you into 2019.
I'm just looking at that picture. I mean, it was windy outside. You can tell from Ben's hair. Yeah. So, we look forward to hearing you. Thank you all for your time this afternoon, and have a great rest of your day.